Vamos a empezar en un minuto. ¿No vamos a usar micrófono? Estas salas tienen sonido ambiental, probablemente no. Sí. Okay. Welcome to this session. My name is Rodrigo Alifat, and I am professor in the Division of Development Studies at CIDE. Today, we are pleased to have a presentation on financial alternatives in developing economies by Professor Jan Toporowski, with commentary by Professor Lisette Ramon. After the presentation, we will open a round of questions. Okay. First of all, let me introduce Professor Jan Toporowski. He is a professor of economic and financial at SOAS University of London. His research focuses on monetary theory and policy, finance, and the work of Michael Kaleski. He also participates on editorial boards of the Journal of Post-Keynesian Economics, Review of Political Economy, and Review of Keynesian Economics. Professor Toporowski has published 2 volumes of biography of Michael Kaleski and more than 350 books, articles, and papers on economics and finance. Before entering academia, he gained extensive experience in fund management, international banking, and central banking. He has also served as a consultant for the United Nations Development Program, the Conference on Trade and Development, the Economic Commission for Africa, and the Economist Intelligence Unit. Welcome to CIDE, Professor Toporowski.
Thank you very much. Thank you very much. Okay, will you pass this? Yeah, maybe I will move over there because I can then change these as I prefer. Yeah. Okay. Thank you very much, Jeff. Thank you very much for this very, very kind invitation to me to speak here on this subject. I would also like to thank in particular the Centre for having supported my stay here, providing transport and support during this stay here in Mexico. This stay, as previous ones, has been very important for my own development. This is always the first place where I come for critical evaluation of my work, and this has been, I think, visible. This is visible, this kind of critical evaluation and feedback in the quality of some of my work on development and development financing. I should say in advance that this is what I'm presenting are the results, or the key results, of a paper that I have published together with a colleague whose I will discuss later on. And so to some extent I share, these views are mine, but also of my colleague. Let me start off by giving a summary of what I will be talking about today. I want to give an introduction talking about how the difficult global integration of developing countries into the global economy, and in particular into the global financial system, and what has accompanied it, which is a periodic financial default. And the last of these was the international debt crisis that was set off by Mexico in 1982, as a crisis in which I myself participated to some extent as a banker, though not as a decision maker. And then the consequence of this long shadow and the criticism of the policies of the development policies that accompanied that debt crisis, and the consequence of this was a shift in the 1990s in financial policy towards an idea that finance is not so much there to discipline governments, but it should also be in the service of what might be called the good economy. And then from this came a certain critical reaction, critical attitudes from those advocating capital controls to certain academics arguing that this was just leading to a kind of subordinate financialization. While all this was going on, there was a major shift in the international monetary system towards swap-based lending and swap-based currency arrangements. And I will discuss this together with a certain proposal that I made with my colleague from the European Investment Bank, and then we'll come to a conclusion looking beyond finance. Let me start off by talking about the global integration and financial default. The developing countries have been characterized by a direct evolution from a subsistence economy into global markets. I would say this is particularly noticeable in the case of the countries that were colonized. America, to some extent, including Mexico, has been an exception to this because America, and as you know from your own history, it was settled in a way that integrated Mexico and North America directly into the international economy. In the case of Asian empires, they developed their domestic markets first and then integrated. When the integration came, it came with the first crisis, 1824. The Republic of Argentina defaulted on its foreign currency debt. What we then see in the case of the developing countries are recurrent cycles of economic booms punctured by debt crises. I won't go into the nature or the cause of these booms or what happened during those debt crises. They were certainly in the late 19th century, associated with imperialism, and then, but also with a kind of distorted integration, an integration that was distorted by the way in which the industrialized capitalist countries used the developing countries as a way of, or as a place to which to export capital to resolve the problems that they had, the capital accumulation problems that they had. This is obvious in particular in the writings on imperialism of the Second International, Hilferding and Luxembourg, but also, but also of other authors, the liberal J.A. Hobson. All of this came to an end with a breakdown of the gold standard and interwar debt crises, which made it very apparent that this kind of the rich countries, the imperialist countries, could no longer maintain colonial control. The debt crises were supposedly resolved by the Bretton Woods system, and a new system of official development finance with the World Bank emerged, but failed with the unofficial, with the rise of unofficial currency exchange markets, the euro-dollar markets from the mid-50s onwards. So this is a sort of prelude to the new type of institutions that emerged with the international debt crisis in particular, 1982. Mexico plays a pioneering role in all of this. I won't go into the background to it in terms of the indebtedness, US monetary policy, commodity prices. But what I will point out was that to some extent it gave rise to what some one or two of my colleagues in particular referred to as a debt run of indebted, mostly middle-income countries. What is a debt run? A debt run is something like a run on the bank. A run on the bank, as we all know, is when the depositors come to a bank and demand all their deposits back. The bank hasn't got the ready cash, and the bank therefore collapses. With a debt run, what happens is something different. It's on the other side of the balance sheet. A borrower realizes or hears that the bank is in a difficult position. What do you do in that situation? Do you continue making your debt payments, or do you stop making debt payments? Because if you stop making debt payments, it will be some time before the bank resolves its problems. And I would say that the debt crisis of 1982 had certain features which were similar to a debt run, in the sense that once Mexico had defaulted, a number of other governments. Once the Mexican government defaulted, a number of other governments defaulted, knowing in the knowledge that the problem was a problem of American banks, fundamentally. The banks had to find a solution. They didn't. There was a struggle in the 1980s. It was characterized by a struggle to save the international banking system. I may say that from the political point of view, it looked like a struggle to refinance governments. But the reason why that refinancing was necessary was because if it didn't happen, then a number of international banks would collapse, and they were principally American banks. So it was up to the American government to try and find a solution, and they did with the Baker Plan of 1985, essentially asking the Chinese to refinance and the banks themselves to refinance, followed by the Brady Plan of 1989, where the government, the US government, offered certain guarantees, the loans would be collateralized with US government paper. Development and concepts of development were replaced by the severe structural adjustment policies of the Washington consensus, what was called the Washington consensus of liberalizing economies, essentially gave rise to the lost decade of development. Development projects stopped. Governments found themselves unable to meet their obligations to their citizens. The situation looked dire. Predictably, the situation changed because of a change of government in the United States when, with the Clinton administration, the disaster of structural adjustment was replaced by poverty reduction as a goal of international finance. In particular, debt reduction for low-income countries through the highly indebted poor countries initiative. Debt reduction, I would say, for the low-income countries, it was relatively cheap because the low-income countries were themselves not highly indebted. The really highly indebted countries of the 1980s and the 1990s, the ones that had got into trouble, were the middle-income countries like Mexico. This was followed, as we know, by the Millennium Development Goals, an era of optimism that finance coordinated by the United Nations agencies could generate economic development, and then this was transformed into the Sustainable Development Goals. And more recently, what was added to this was the Paris Agreement on climate change, giving rise to a boom in the idea that international finance really should be green finance, should be greening the planet and not just providing for development projects. The critical attitudes towards this came from a number of sources. A common one was the were the proponents of import substitution, who criticized capital account liberalization. They criticized the notion that free movements of capital would give rise to international or would give rise to development in the poor countries. They were a number of theoretical positions behind this, but their origins lie in the ideas really of Raoul Prebisch from the 1930s onwards, which was a suspicion of the international monetary system, a suspicion going back to the days of the gold standard, which, according to Prebisch, was being run for the benefit of wealthy countries and to the disadvantage of developing countries. So that if a government or a country wanted to develop, according to Prebisch, it needed to have monetary autonomy to be able to fix its exchange rates and its interest rates. And on this basis, it could achieve economic development, since after all, this was what the rich countries had started with. This view found its echo in the 1980s and in criticism of the structural adjustment policies, criticisms of the liberalization of capital accounts, according where the critics argued that this was creating instability in developing countries, and it was associated with unstable capital flows and financial crisis. This particular view put forward by certain post-Keynesians, but also even if not particularly post-Keynesian, but critics of the international liberalization. Among post-Keynesians and neo-Marxists, a view developed that finance, in any case, as it was developing in the developing countries, was not doing what it supposedly does in the financially advanced countries. It was not properly supporting investment and economic development, and they developed the term of subordinate financialization for this, linked to the idea very clearly here in Mexico that the banking systems, with liberalization, banking systems became were taken over by principally the international banks based in the rich countries in the US and in Europe. But they, unlike the proponents of capital controls, this concept of subordinate financialization always remained rather vague as to what were the processes by which this finance in developing countries was becoming inadequate. Was it just foreign ownership? Was it a kind of predatory lending? It wasn't clear. Let me move on to really the main point of this talk, this lecture, and that is the restructuring of the international monetary system that occurred in the 1990s. In many respects, these criticisms about capital controls, about subordinate financialization, were rooted in a critique of of capital account liberalization and the Washington Consensus, and a focus on that Washington Consensus and the capital account liberalization, not realizing that in the 1990s there were already changes taking place in the international monetary system that were altering the situation, and in many respects requiring new solutions for the financing problem, for the financial problem of developing countries. The shift, the restructuring started with the Basel Agreement. The Basel Agreement of 1988, which was an agreement made by the regulatory committee of the Committee of Bank Regulators of the Bank for International Settlements in Basel. The reason for they had come together, they'd been brought together at the request of the central banks to discuss how to resolve the problem of banks getting into overlending to developing countries. And in particular, this was part of the effort to save the international banking system in the international debt crisis, the principally American international banking system, which had got into such difficulty in the 1980s. The Basel Agreement came to a typical banker's solution. A banker's solution always is that if you're worried about how good your loan is, whether it will be paid back or not, then look at the security that is offered. Ask if there is any security that is offered, and if necessary, take the security and put it in the bank's safe, so that if payments cease, then the bank can take over ownership of the security. That was the fundamental problem of the international debt crisis, that the borrowing that governments, developing country governments, had done in the 1970s and the 1980s in the euro dollar markets, that borrowing had been unsecured. So what the Basel Agreement did was it imposed certain capital penalties, certain requirements for additional capital, depending on what was the quality of the security for the loans. If it was if the security was were the bonds issued by OECD governments in Europe and North America, then this was considered to be not risky at all. If it was lending backed by guarantees from governments of developing countries, or backed solely by a promise by a business in a poor country, then that was risky and had to be backed by capital. So it's this concept of secured lending as being the best lending possible that was established by the Basel Agreement of 1988. The second feature that emerged was the return of central bank operations in money markets. During the period of monetarism in the 1970s and the 1980s, central banks were supposed to observe the money supply. They were not supposed to look at, they were not supposed to bother with the rate of interest, or to look at, or to use open market operations, other than to ensure that the policy rate of interest was enforced in the markets. In the 1990s, this changed with the collapse of monetarism, the emergence of inflation targeting. Lending was introduced in the form of swap-based lending or repurchase lending. In other words, a central bank would agree to buy an asset, and this would be backed by an agreement to reverse that transaction after a certain period. Now, if you understand balance sheets, you realize that what this simply means that the central bank is lending the money. But the central bank is not just lending the money. The central bank has security for that money. And the security is that agreement that the asset which has been purchased will be sold back again to the same person, the same institution from which it was purchased. And what this did was it started a process of the drying out of interbank markets for unsecured lending. The interbank markets traditionally have operated on the basis of the lending being unsecured, but in the knowledge, the only guarantee that was offered was that the bank was a recognized bank, recognized by the central bank, and had a good reputation. What happened after this, the repos started coming in the 1990s, was that the interbank market started drying up because it became easier to borrow using repos, easier and cheaper because you had less capital had to be set aside for secured lending as opposed to unsecured lending. If this lending was happening, since a lot of this lending was happening with the central bank, what you found was that from the 1990s onwards, central banks start taking what should have been an interbank market onto their balance sheets. In effect, the interbank market starts to be a market that's operated by the central bank. And the actual interbank market starts to dry up, and dried up to the point of 2008. A large part of the 2008 crisis, one of the contributory factors was this drying out of the interbank markets, as well as the ostensibly because of the fear that a bank that wanted to borrow unsecured was a bank that was liable to be in trouble. So this gave rise to the 2008 crisis, and part of the response to it in the academic literature and in the central banking literature, which was to say that this swaps-based lending was actually shadow banking, and the problem was that it was less regulated than the interbank market or banks regulated by the central bank or the banking regulator. At that time, it was fashionable to have a separate banking regulator. The other thing that emerged around this time were currency swaps. Currency swaps being swaps of central bank reserves. Their origins are really in the 1960s, gold swaps, when the international monetary system was, and in particular the United States, was starting to run out of gold reserves, and a way of making the gold reserves last longer was for the central banks to swap them as required. The swaps were again the purchase agreements, which were then reversed, which were then to be reversed after a period. But it meant one thing it meant that a central bank could have enough gold, or could lay its hands on gold to overcome a crisis. But secondly, what's interesting about this is that it's in effect increasing the efficiency of gold reserves by increasing the velocity of their circulation. If their ownership is circulating like this, then the velocity of circulation is going up, and a given quantity of gold serves more frequently to equilibrate the markets. Well, it didn't in the end. The gold standard collapsed. In 1994, the Federal Reserve introduced foreign currency swaps. By now, these are just swaps of US dollars against the currencies of Canada and the Mexican peso, and under the NAFTA agreement.
Also with Brazil.
Sorry?
With Brazil also.
With Brazil also, okay. Yeah. I thought it was Brazil was in there somewhere. So you had, and then in 2007, these swap agreements are extended to the European Central Bank, the Swiss national banks, central banks in the UK, Sweden, Denmark, Japan, South Korea, Australia, and New Zealand. Yes, Brazil was there. In during the COVID period, actually during the 2010 crisis in Europe, the swap facility becomes unlimited to the European Central Bank, and again it becomes unlimited during the COVID period. There's one issue which puzzles me, and I need to talk to someone about this, and that's the question of the exchange rate that's embedded in a currency swap, because the currency swaps are made at when they're reversed, they're reversed at the same exchange rate as previously, so that the central banks, one of the central banks takes the foreign exchange risk if there is a run on that currency. And I'm told that this is one of the reasons why actually these currency swaps have not been used very much. They have been used but currency swaps between the central banks. Something else, which is the foreign exchange swaps between commercial banks. So what we have, therefore, is a new international monetary system based on repo lending by central banks in the USA and the other OECD countries. In the case of the other OECD countries, these repo lending agreements are limited by fiscal rules. Government outside the United States, well, actually even in the United States, but as a formality, governments are limited by fiscal rules in the amount of debt that they can issue. And this is what's given rise to a shortage of good or investment grade assets. This is something that my friend Fotis Lysandrou talks at great length about. There is indeed a shortage of investment grade paper. The reason being that this paper is mostly issued by governments or issued under government guarantee. And why does this then become important? Because it then limits the amount of credit that may be obtained using those assets as security. So there's repo lending by central bank in the USA and other OECD countries, and then the second element of the international monetary system are foreign exchange swaps between commercial banks. If a Mexican bank wishes to lend money wishes to borrow money, then it can or lend money. The easiest thing to do is to buy dollars through a swap into pesos, and lend those pesos out, so that in effect this leads to a certain dollarization. But because these agreements are backed by a swap, then there is a reverse agreement which serves to back the lending. What this in effect means is that domestic credit markets are being internationalized and they're being dollarized, not in the sense that retail customers use dollars or use in the place of the domestic currency, but because banks increasingly back their domestic lending with foreign exchange swaps. It's cheaper because it's secured, and it doesn't. And the reserves are essentially the collateral of the swap agreement. This is why, when the crisis hit Europe in 2010, part of the solution for it was the currency agreement between the US Fed and the European Central Bank to supply dollars. Why were the dollars needed? The dollars were needed to roll over the foreign exchange swaps using dollars. In other words, Europe is with a currency that was intended to act as a substitute for dollars in international trade, has a monetary system that is increasingly based on the dollar. We don't see it because this is in the balance sheets of banks, and not even very often, not even in the reported balance sheets, because these are in futures or forward contracts that are not don't have to be reported. Now, for developing countries, this leads to a local currency lending problem. Developing countries find that they can get multilateral lenders to lend to governments in international reserve currencies, in dollars, yen, or euros. Commercial banks, by that I mean foreign commercial banks, will also lend to private sector borrowers in international reserve currencies, dollars, yen, or euros, but they have difficulty in raising domestic currency for lending. They don't have deposits in domestic currency, and this lending of in international reserve currencies gives rise to foreign currency indebtedness and debt crisis. This, as happened in 1982, periodically in Mexico in 1994, and it's associated with the financial underdevelopment in developing countries. Financial underdevelopment in the 1990s, I've already mentioned the shift in official policy of the Bretton Woods institutions of the World Bank and the IMF under the influence of the Clinton administration and Stiglitz towards a kind of a more benign treatment of developing countries. In particular, with Stiglitz came this new Keynesian idea that, or a new Keynesian critique of liberalization, market liberalization, arguing that it was first necessary to establish institutions and markets before you liberalize. If you just liberalize, you got into a crisis and chaos. And essentially, what it did, what happened with this was that development finance starts to become directed towards financial intermediaries. The belief that you can, through multilateral agencies, provide some kind of development finance. But then from the roughly the turn of the century, there is an idea that you can overcome this financial development, this inability of banks to lend sufficiently in their domestic currency. The various schemes were put forward for mobilizing domestic financial resources. But this was done in an unsystematic way. You find UN agencies talking about mobilizing, and the IMF talking about mobilizing domestic resources, financial resources. Quite how is not clear. In many respects, just simply becomes an excuse for lending money to banks. In all of this, I started having discussions with a friend of mine, an Italian, Massimo Cingolani, who works for the European Investment Bank. We were talking about this problem of the difficulties of so-called mobilizing domestic financial resources. How can one do this if in the face of pressure just simply to fund things with foreign currency and to use the financial centers in the US as essentially funding centers. We eventually came up with a suggestion, a proposal that whereby it was really aimed at the European Investment Bank, a multilateral lender like the European Investment Bank, but it could be the Inter-American Development Bank, enters into an agreement with a central bank in the developing countries to swap the lender's foreign currency for the developing country currency. And the agreement is backed by a reverse agreement at the same exchange rate, so that effectively the developing country central bank takes the exchange rate risk. Well, they take it anyway if they borrow in foreign exchange. The important thing is that this lending is now on the books of the central bank. It's operating on the books of the central bank rather than through the international money markets. The central bank or the multilateral nominates a local commercial bank for the financing project, and it has therefore the money or the credit to lend locally, backed by these swap agreements. There are various hedges in these arrangements. Hedging, if you're a finance person, hedging is simply the financial arrangement to ensure that it becomes possible to make the payment in a credit agreement or a loan agreement. or the financial agreement that's entered into. The hedging arrangement in this are quite simple, that the central bank has the foreign currency counterpart of the local currency lending, so that is hedged. If the central bank holds that, can either hold that foreign currency, put it on deposit with the Bank for International Settlement, or it can buy foreign assets to hold as a hedge against the reversal or the repayment of the original swap agreement. So this works as a hedge. The other thing about this is that it introduces an important institutional hedge, which had been removed with the breakdown of Bretton Woods. Under Bretton Woods, the international transactions, because of widespread capital controls, international transactions went through central banks. They were on the books of central banks, and central banks could make settlements with each other's on balance, or in various ways that would allow, would facilitate the payments on loans. With the breakdown of Bretton Woods, this gave rise to a privatization of development lending, the Eurodollar lending. This was a form of privatized lending. At the time, the advantage was that, of course, it wasn't the IMF, it wasn't subject to restrictions. In effect, the swap-based system brings back central bank settlements system of international debt management. So it does become a way of stabilizing the system. The central bank provides an indemnity against exchange rate changes because it's obliged under the swap agreement under the reverse swap agreement to exchange at the same exchange rate. But this is made easier by the fact that it has the original foreign currency. And I guess there is a question as to the extent to which this is a commitment to fixed exchange rates. To some extent it is, and I think it's noticeable that under the system of foreign currency swaps as backing for lending, the foreign exchange rates, have been relatively stable. When I say relatively stable, I'm not saying that they haven't gone up and down, but when you consider the kind of financial instability that we've had, the 2000 dot-com bubble crisis, the emerging market crises, the 2008 crisis, the COVID crisis, exchange rates really haven't moved that much by comparison with their movements during equivalent periods, let's say in the 1970s. Yes, it's possible that a new era of relatively fixed exchange rate. But the point about this is that I think that the proposal has development potential because it's project focused. it can be focused on climate projects or specific development schemes. These can be, as opposed to more general buying and selling of currencies for in order to buy or sell financial assets or other kinds of assets. You can use it as it's project focus, and I would say it's certainly an advanced on new Keynesian institution building, because that was really a system of improving bank balance sheets rather than actually providing finance for specific development projects. So I think this is a good proposal. I show at the end the reference to this. It appeared in the Cambridge Journal in the last Cambridge Journal of Economics. Massimo, my colleague, is a devotee of a certain kind of the circuit theory of money. But if you can wade through some of the terminology of this circuit theory of money, I think this is it doesn't solve everything. It doesn't even solve half the problems of developing countries. But I think it is an interesting proposal at the margin. So I'll finish there. Thank you very much.
Thank you, Professor Toporowski, for your insightful presentation. Now, we will hear comments from Professor Lisette Ramon. Let me introduce Professor Lisette. She's an associate professor at CIBE and has a PhD in economics from UNAM. Her research focuses on investment, productive structure, and structural change in developing economies. She previously taught at the Technical University of Loja, and Professor Lisette has published in scientific journals on topics as rural development, economic growth, and education. You have 2 hours.
Thank you. First, I would like to thank Professor Toporowski and Dr. Alipat. Before today, I had to know the professor only through his publication. This A Proper Financialization is one of them. And I would like to say that my interview, beyond critique the contributions of Professor, is deeper your contributions to understand and apply in our countries. I have 4 points about his presentation, his lecture, and the first is about historical evolution of development finance. The professor traces a historical path from the global integration of the developing countries and the recurring debt crisis through the failure of the Bretton Woods system and the last decade of 1980, under structural programs. This historical perspective is crucial to understanding the persistent challenges and lessons learned in development financing. The second point is critiques of conventional approach. His lecture also addresses critiques of conventional approaches such as the subordinate financialization of developing countries, where the financial system does not perform the same functions as in developed countries. And it also highlights the importance of capital controls to avoid unsustainable capital flows in line with post-Keynesian proposals. The third point, I think, is swap-based restructuring proposal. One of the key contributions of the lecture is the swap-based restructuring proposal of the International Monetary System developed by Professor Toporowski, co-authored by Cigoliani. This proposal aims to address the problem of foreign currency indebtedness and financial underdevelopment in developing countries by linking development lending swap agreements between central banks and multilateral lenders. It seeks to mitigate exchange rate risk and promote the development to local financial markets. And finally, is the potential and challenge of the proposal. The swap-based restructuring has the potential to link financial to specific development projects, as Professor told us, such as those related to climate change. And in our countries, it could be an opportunity to have the capital requirements for manufacturing development. And however, it also poses challenges in terms of central bank autonomy and possible implications for fixed exchange rates commitments. And it's important to consider these aspects when evaluating the feasibility and potential impact of this innovative financial proposal. So I have just a little bit question, Professor. And it's about the implications that your proposal have for the autonomy of central banks in general, and in particular, and in some countries where there aren't the autonomy monetary, because it's like the example that you told us about dollarization. Europe is the same, but it was temporary, and some countries the system is not autonomous. So what are the implications of your swap-based restructuring, Professor? Yeah, it's just first. No, it's just one. So this first main question. If you want,
I think that in a sense this system gives the central bank leverage because in particular it has if it has responsibility as the intermediary between the multilateral lenders and the domestic lenders. This is not something. This gives, I think, the central bank a certain amount of leverage from with the government, in the sense that I think that if we all know that the problem with, or the unspoken problem of lending to developing countries is that there are certain regimes that, quite frankly, one does not want to lend money to. And if there is a system of well, central bankers in those countries know that they would not normally have access to multilateral borrowing. If they had access to multilateral borrowing, then they would have obligations towards the multilateral lenders, which, as I say, would give them, which would be an argument vis-a-vis the government. It would also be an argument over exchange rates. I think it would give central banks could give and contribute in a much more authoritative way to the debate of what is the role of exchange rates in economic policy. Should exchange rates matter? In particular, should exchange rates matter when we're talking about domestic development using domestic resources? We know that exchange rates matter. We can go back to the disputes about fixed and floating exchange rates never actually went on, have never been resolved. and they've never been resolved because they are more, either one of them is better under certain circumstances than others. And the central bank should have play a role in this. But I would say, you know, on the whole, my sense is that the stability of the financial system is improved if you have stable exchange rates.
Thank you, Professor.
Okay, thank you, Professor Lisette, for your comments. Okay, we have 1 hour more. No. We open a round of questions. Does anyone have a question? Questions? Okay.
Okay. Actually,
One last comment.
no, I mean, maybe I can ask a question. Is there discussion? How big is the discussion? Is there any discussion at all in Mexico about the swaps-based system, credit system?
It has been accepted, especially the swap system with the US with the help.
Yeah.
Has been very helpful.
Yeah.
Although ideologically it has been criticized.
Yeah.
But when you have very unstable moments,
yeah.
you know that you will have these dollars.
Yeah.
You don't know how much you will pay for that. This is another problem.
Oh yeah.
But the liquidity is there.
Yeah.
And there are a lot of discussions of having it or not. But on the general, I would say nobody disputes them. Let's put it that way.
Yeah, I mean, I think it's, you know, in some respects, yes, it ties Mexico to the US, but also ties the UK to the US.
It was done after NAFTA, I understand.
Sorry?
It was done as a result of NAFTA.
Yeah.
The Shabbat. I remember it was after the debt crisis in 1994, which came actually before NAFTA. It was after the debt crisis, which came Mexico and then Brazil.
Yeah.
Sort of sure, we'll see in Google when it happened with Brazil. But I'm sort of certain that it was because the United States also needed some stability here.
Mm-hmm. Yeah.
For all the what happened in NAFTA.
Yeah, I mean, also because the United States learned its lesson from the 1980s, that if it wants to have international banking, it needs to support international banking. And similarly, I guess for Mexico, if it wants its banks to have if it wants Mexican banks to have a claim on American dollars, let the American.
But you don't have Mexican banks. Well, the banks operate in Mexico, which are multinationals.
Yeah.
So you don't have any problem of accessing to liquidity.
Mm-hmm.
But they have.
Actually, have to like the swap with China. Mexico government goes up to China.
Yeah.
Also, Argentina, Brazil, Argentina have a very important swap that make
They would have had it by now. Well,
they use the swap to pay the debt with IMF.
Yeah.
In fact, China has around 40 swaps with development countries. But I think that in the proposal that you see, but we have taken some ways in that proposal. However, when we here to the banks a lot of currencies. Plus, we can for other, the big actors like BlackRock or similar that could take all the currencies and get away.
Okay, another question?
I have to, well, Professor. I could hear you yesterday. And in your lecture, you conclude that finance is the consequence of development in industry materials. So today we have this innovation in the form of financing, and one form to apply this for this instrument is in projects. So it's causal. I need financing some projects, industrial projects, to develop, and at the same time, the financial system will grow or not. How is the relationship?
It relates to this in the sense that if you have as a country industrialize it. Let's take infrastructure program with an infrastructure program. The key the money that's spent on the infrastructure program ends up through monetary circulation, through the multiplier process, ends up being held by business, by business, local businesses, and so on. Most of it probably will go to small and medium-sized businesses and circulate there. Once you have, and this is what I mean by finance being the consequence of development. Once you have an industrialized economy and an industry is owned by corporations, then when money is spent on infrastructure projects, it ends up in the balance sheets of those corporations and ends up being concentrated in the money markets through the multiplier, ends up being concentrated in the money markets. And this is why and once it's there, what do they do with this? Well, they use the money to buy bills, financial assets, and so on. But it's the development of corporate finance that comes with corporations, holding companies, and big business. This hasn't happened in Mexico because Mexican big business prefers to use the money markets in America. If you want to start developing the money markets of Mexico, well, first of all, you have to develop the government bond market.
It is developed.
Sorry?
It is very developed.
Yeah.
The bond market.
Yeah, the government bond market.
Yeah.
Okay, and with that bond market, these other instruments such as repos using government bonds. So you effectively you have to have financial circulation, but the financial circulation is not development in itself. the development in itself is the infrastructure, is the public public services, health, education, and increasingly the issue of green projects.
Okay, Professor Bobrowski, Professor Lisette, thank you for this engaging session. Professor Bobrowski, we hope to see you again at CIBE. Thank you very much.
Thank you very
I
much.
have a present for you. Oh, for 50 years.
This is very nice.
Se cortó un poquito.